Are you a sophisticated investor looking for investment opportunities in the non-bank funding market? Perhaps you're a business owner, a property industry professional, a property developer between projects, an experienced investor, or an SMSF trustee. Whatever your profession or stage of life, Holden Capital Partners, HCP, has investment options suitable for you. HCP provides property developers with debt and equity solutions for all stages of a project's lifecycle, ranging from site acquisitions through construction and completed stock loans. HCP provides funding for residential projects such as land subdivisions, townhouses and apartment projects, as well as retail, commercial and industrial developments all over Australia, with a strong focus on the eastern seaboard. So where do the loan opportunities come from and how does the process work? HCP's deal flow comes via long-term repeat developer clients, brokerage referrals and direct inquiries from developers. This provides HCP investors with exclusive access to a constant flow of quality loan opportunities to consider. For each loan application, HCP undertakes a thorough review of the project feasibility, strength and experience of the sponsor and the proposed exit strategy. All loans must be unanimously approved by the HCP Lending Committee before a funding offer is issued. HCP's custom-built investor portal allows investors to track all of their investments easily in one place. Once a new opportunity has been released, an email and text is sent to investors, inviting them to invest in the loan and presenting them with an information memorandum, which outlines the loan term, security, forecast net return, sponsor and project details, and any other relevant information to help them make a considered investment decision. The investment opportunities HCP presents to its investors fall into three categories, with varying risk-reward structures. Let's take a closer look. The first category is first mortgages, which features first mortgage security, 10 to 15-month investment terms, 9 to 12% per annum. The second category is second mortgages, which features second mortgage security, 10 to 15-month investment terms, 16 to 22% per annum. And the final category is preferred equity, which features a general security agreement, 6 to 15-month investment terms, 25% plus per annum. As HCP provides you with the opportunity to participate in multiple standalone select loan investments, it enables you to build a portfolio based on your individual preferences. Start investing today by registering at www.hcp.fund.
Thanks very much, Darren. Great to have a good chat with a lot of you this morning. And as we've said, when you've come along to the booth, I won't give you our elevator pitch twice, so we'll keep it just to this one. All right, a little bit about the lending landscape. So I suppose pre-GFC, the banks had gotten to a level on their books in terms of commercial property loans that they never really wanted to or needed to get to. And GFC almost was used as an excuse to bring back those levels to pre-GFC levels. And so banks make their money out doing 30-year home loans, not giving a property developer $5 million for 12 or 18 months to build a duplex or some townhouses. And so where the banks do lend, and they do have good long-term quality borrower clients, it tends to be very much focused on serviceability of that debt, and it also tends to be focused around pre-sales. So in our presentation, we'll cover a little bit about that. There's a bit of a misconception that if a developer is getting non-bank lending, that they must be a terrible person and the people who are giving them the money are lenders of last resort, but that couldn't be further from the truth. So the benefits of non-bank lending. So we don't require pre-sales. Holden Capital Partners, we don't lend to pioneering developments. We don't lend in places we haven't lent in before. So if someone's doing over 50s retirement village in Mackay, it's sorry, we can't be all things to all people. We have no idea what that is about. We couldn't tell you the valuation, whether it's correct or not, so we don't do that. We're fast, so with the banks, or even the minor banks like a La Trobe, for example, we got a lot of property developers come to us and go, we've been spinning our wheels, should I say, for many weeks and months with one of those, either a bank or the likes of La Trobe, can you please come in? I've got a builder ready to start on site. And so they normally have a valuation and a QS lined up, and we can settle in around 10 to 14 days from engaging with us. And it's great because we look superhuman because they've already been burnt out with the other process. But I'd say if we fund 25 transactions over the last 8 to 10 months, probably about a third of those have been through that process where they're just so fatigued and they come and we're 2 or 3% more expensive. But if you start with us 3 months ago, you'll have slabs down by the time you've got an approval or not. We're not focused on pre-sales. We more look at, does the project make sense? Is it pioneering? Is it not? Is there market depth for the end value of the project? And if there is, that's what satisfies us more than anything else. Serviceability. So banks are massive on serviceability. So I'm lending a developer $5 or $10 million. Can he service that? The reality is that property developers have very lumpy income. So all their equity goes in up front at the start of the project, and they don't get paid till the very end. That could be 12 months, 15 months, 18 months. It's a long period of time. And so to actually want to put in a serviceability calculator that these guys can pay it back monthly, they actually can't. And that's the reality of property development lending. So when we provide a finance solution to these developer clients, and I'll touch on our metrics a little bit later on, we lend 65% of the end value of the project exclusive of GST. So if they're building 10 townhouses with an end value of 1.1 mil per product, it's a mil ex GST. 10 mil is what we lend against, and our facility will never exceed 6.5 million, which is 65% of that. And within that 6.5 million, let's say it's a 10-month or 12-month transaction, will also allow for capitalized interest of 12 months within the facility. So we don't just go, here's $6.5 million for your 10 townhouse project, hopefully you pay us back in 12 months. It's very much progressively drawn. So the superintendent signs off on the builder's claim, and then our quantity surveyor reviews that sign off, goes out to site, makes sure that everything that's been represented has been done, and then signs off, and we progressively advance it to the developer during construction. All right, so who's HCP? So Holding Capital Partners, we're a non-bank lender. We're established in 2017, and our credit committee comprises myself, Dan Holden over here, and Steve Wilshire and Paul Wood. So we've got about 100 odd years experience between us in the non-bank lending space. I've spent 16 years in first mortgage lending. Dan is many more. Steve Wilshire was head of property in Macquarie Bank in Queensland for 28 years. He was on the non-exec committee board with one of the major banks. And Paul and I worked together for 8 years in the past, and he's our head of credit now for the last 2.5 years. So he's had 25 years, give or take, in the game. A few more of our staff there. The average tenure or the average amount of staff that we don't have staff turnover. So 83% of the current staff have been with us for 6 years or more. So that's probably testament to our business, especially in a generation where a lot of the younger people, and I'm not classing myself as a young person anymore, they're in a job for a year and they get bored and they want a $5,000 pay rise and they jump to somewhere else. We haven't had that, which is fantastic. Who do we lend to? So going back to my previous comment about these borrowers being terrible people, and if they can't get bank funding, they must be no good. They're very much bank quality clients, but they've either reached their cap of lending with their bank or they want to overlap their projects. And so we have the ability to give them greater flexibility because they don't have to meet that serviceability requirement, but also on pre-sales. So during, I suppose, COVID, what we saw is that obviously prices rose as a result of labor costs and also materials. And it was all about the materials at the start, right? It was timber and it was metal and whatever else it was. And then it became about labor. And so the costs were going up. And so if you had pre-sold that product, your revenue was capped at a certain level where your costs were going like that and your profit was probably no more or a lot lesser figure than you had in mind. Whereas those that didn't have pre-sales, as we've known, the market has moved pretty much parallel, or whatever that's called. You know what I mean? They both went up at the same or similar incline. And so everyone now has that, scarred. People who got pre-sales and didn't make profit are scarred. So they're like, we're doing 10 townhouses in X suburb. Do you require pre-sales? No. What's your cost of funds? 995 or 975 per annum. What if I have 5 pre-sales? 975, 995% per annum. It's a nice to have, but it doesn't come into our metric for lending. Our focus. So our focus is very much on the eastern seaboard. So a bit about what we do and a bit about what we don't do. So we do townhouses, houses, land subdivisions, and a little bit of mixed use. We don't do anything with a basement or a double basement. We don't do high-rise. We don't do units. We don't do aged care, NDIS, any of that kind of stuff. We can't be all things to be all people. We focus on our wheelhouse. So a lot of you here today, and having good chats with some people this morning, invest with, Max Cap, Qualitas, Latrobe, you name it. We're not down here from Brisbane pitching that we're going to bring you Melbourne transactions, because you're already getting that deal flow from those lenders because this is their backyard. And that's who you should stay with. Our elevator pitch, to call it that, is that we've got a very established business in Queensland with some really good long-term clients, and you can gain access to them through our investment vehicles. So last year, we did $105 million worth of lending, and 70% of that was to long-term repeat borrower clients, which is of massive value to us on a credit level, but also massive value to our investors, because if they've invested with Joe Bloggs 6 times in the past and they see his latest deal, it's like, great, obviously read the IM in full and understand the project, but to a large extent, they know that this guy has delivered before and they know the name, which is very good. Yeah, that's just a bit more about Queensland. In general, there's a lot of hyperbole at the moment about the Olympics and how property prices are going to treble and quadruple. That's not going to happen. I think there's a lot of people using that as for their own self-interest. But I think what it'll do is solidify an already solid market. We've been asked about whether all this big infrastructure projects will sap a lot of the workforce out of it and it'll affect the industry and what we lend to. The answer is no. If we've got, Chris the Chippy doing 2 houses in the burbs, he's not going to work on a big infrastructure project. So we don't see that affecting the type of projects we lend to. It's illustrative of 2 long-term clients of ours. So Michael from DevCon, bank client, still funds a lot with bank, but if he's going to a non-bank, where he's non-bank of choice, and he doesn't get another quote, which is great. And I think if we were bad people to deal with, and if we were too expensive or whatever else, these guys wouldn't be using us. Likewise, Ron from HomeCorp. HomeCorp do a lot in Victoria as well, and I'll cover one of their deals later on. Those guys, when we started the business, and we'd known them for several years prior, I think Dan has banked Ron since 2004, 2007. In 2017, at the back end of the year, the first 2 deals we settled were with Michael and Ron, and we've settled a deal or 2 each year ever since, which is fantastic. All right, so who invests with us? So I'd put our investors into probably 3 subcategories. So we've got 1 ASX-listed institutional investor. We've got 3 large family offices in each state, like Victoria, New South Wales, and Queensland. They're like BRW top 30, 40 type families. And then we've got probably about 110 SMSFs, business owners, professional investors, you name it. So I was at a presentation, before, and some people have tens of thousands of investors. We don't. We're probably about 130 all up. And the benefit is, if you invest with us and you pick up the phone to invest in a month or a year, you'll talk to me or you'll talk to Dan. You won't be talking to some college grad that's fresh out and doesn't know what he's talking about. We have a small, tight team, and you get to speak to the same person the whole time, which we think adds tremendous value to investors, and that's certainly been the feedback. Okay, so what we do, it's not pioneering, it's not rocket science, you've seen it before. We're a non-bank lender. We don't run a pooled fund. We lend to individual projects, and HCP investors participate and pick and choose the projects they invest in. So there's no cross-contamination with another transaction. So that notional example I gave of the 10 townhouses, if you go in that 10 townhouse deal, you're in that deal. Every month that we do a progress drawdown via the QS, we send out a 2-page project update, which is along the lines of, here's what's happened on site, here's the amount we've approved, here's the cost to complete the project, and we confirm that we hold 100% cost to complete plus contingency, and we'll have a few photos in there. From time to time, the marketing people will force us out once a quarter, and we'll take some videos and whatnot as well, and we'll also share them with you. The minimum investment is 100,000 per deal, and the loan terms, it says there, is 6 to whatever months, I can't read it. It's normally about 12. 12 to 15 is our general loan term. Most short-form construction transactions should be able to be built and exited in that period of time. The likes of a land sub, obviously you've got 6 to 7 months of civils, and then you've got your plan sealing and your titling and your sell down. Residential houses, 10 to 12 months. That sort of 12 to 15 months broadly captures the type of projects that we fund. Where are we? So first mortgages, so we do a little bit of this stuff in grey, but on our investor portal, which I'll show you in a minute, it's all first mortgages, 65% of end value. Our rate for the last probably 30 months to the property developer client has been 9.95% per annum. It's starting to come back probably to about 9.75 now. We haven't lost any transactions recently as a result of pricing, but we also acknowledge that the cash rate has come down a bit, and we feel that if we can still return our investors, circa 10.2% per annum, capitalized, because the developer isn't servicing it, it compounds and capitalizes each month. So if it's a 9.75% interest rate, the investors get about 10.2 at the end of the loan. Transparency. So I've looked at a lot of competitors' IMs, and I couldn't tell you, and I'm in the game, who gets what. With us, we get paid an establishment fee by the property developer, ranging from 1.5 to 1.95%, and 100% of the interest rate that developer clients goes to our investors. There's no monthly or annual management fee, nothing like that. 100% of the investors get the interest, which we've got obviously good feedback from over the years. Investor portal. So during COVID, we invested a lot of time and money custom building our investor portal. So there's lots of investor portal providers out there, but everyone's business is a little bit different, and it's pretty much impossible to get something out of the box that suits your business. So we've come up with our own investor portal, which everything from your tax statements to your investor memorandums to your anything that you need to provide to your accountant can all be accessed via the portal. All the new deal releases are sent out via the portal. Okay, so since 2017, 500 mil, which was a nice little milestone we reached around Christmas of last year. We're at 548 million as of today. We're on course to be close to 600 million by Christmas. Over that period, we've had zero loss of capital to any of our investors, which obviously is a record we're very proud of. So this is illustrative of some of the transactions we do. And I won't go through them line by line. You can see them on the screen, and they're in the brochures that you have on your table. But this is the type of product that you'll get delivered on our portal. So it ranges from residential houses to land subdivisions to industrial. And we love industrial. Industrial is great because you go from a vacant block of dirt to slab down to tilt slabs up and roof structure on in 16 weeks. And then obviously there's the internal fit out, etc. So we're real big advocates of industrial projects, and they've gone very well from us and our investors. So we're in final loan documentation with that developer client, Home Corp, that I mentioned earlier on their latest project. So last Christmas, mid-December last year, we helped them acquire a big block of land in Fernsvale in Queensland, which has 3 stages already approved for 130 odd lots, and it has balancing Globo land for another 200 odd. So 15 million purchase price, we put in 8.1, they put in the balance. We're now ready to commence stage 1 work. So the civil contractor has been on site for 4 weeks. The quantity surveyor has signed off on the first progress claim this morning, and all things being equal, we'll be looking to settle this transaction by the end of the month. So it's a first mortgage. It's 13.36 million loan amount. We're 63.4 LVR inclusive of capitalized interest. So that's a big point, because if you're allowing someone to service interest, it means that you're giving them 65% directly towards the project. And if they miss an interest payment, or if they default on their interest payments, your LVR is going north of 65 at a rapid rate of knots. With us, it's already built into the facility. So if any of you guys listen to our presentation and like what we have to say, on your desks and on our stand is the sophisticated investor certificate. And so if you just provide that to your accountant, email it through to me, we'll get you signed up on the investor portal. In Sydney, we had a lot of investors go, oh yeah, I've done something similar. I have to give you 200,000 to start off and see your transactions. No, it's free, no obligation to join our investor portal. You get sent the transactions as they come up. If you like them and you want to jump in and invest in them, great. And if you don't, you don't. There's no trouble whatsoever. So we don't have any sort of give us your money now and hopefully you find some deals. It's a very relaxed approach. Some nice testimonials there from Gary and Steve. So Gary and his wife, June, have been with us from the very start. They're unreal. Inspiring story, actually. I think they had like a cleaning business, Dan, wasn't it? And they obviously made a few bucks out of it. And I think we have 38 transactions at the moment, and I think they have 100,000 in every single transaction. So they're one of our biggest supporters. And Steve in Sydney, who's been in 25 investments with us. Steve rang me one day and he said, I've met you once before in an event. I'm going to start investing, going to put my toe in the water. And he put 100,000 with us. And today he has 22 million. We caught up for dinner with him on Monday in Sydney. Thanks for your time.